Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Okay, we stay with AI with someone who knows a lot about what's going on in this space, and of course the top players, folks like Elon Musk and others, which leads us to our own Ashlee Vance and his story on one of the big names in the space who we finally have an idea of what exactly he's been up to for the past couple months. We're talking about Ilya Sutskever, the famed researcher who co-founded OpenAI. He was in the news a lot last year, Carol, but he's been quiet for a little over a month.
Alas, quiet no more. He talked exclusively with Bloomberg Businessweek features writer Ashlee Vance. Ashlee, of course, author of Elon Musk, Tesla, SpaceX, and the Quest for a Fantastic Future, and When the Heavens Went on Sale, the misfits and geniuses racing to put space within reach. The latter, by the way, the basis for an HBO documentary coming out in July. Ashlee is a super busy dude. He is with us. Ashlee, good to have you here. Ilya, one of the big ones when we talk about AI, remind everyone why he is so important and why we follow what he does.
Yeah, I mean, he's maybe the biggest. He starting around 2012 when he was a researcher, he really kicked off some of the most important breakthroughs that started this modern AI race as we know it. He went on to work at Google and then co-founded OpenAI, and it was really just the presence of Ilya being at OpenAI that made it kind of a real thing and attracted all these other researchers. And then obviously since then, OpenAI went from this underdog to overtaking everybody, and a lot of people attribute Ilya's insights to that success.
But no longer at OpenAI. What do we know, before we get to what he's working on now, what do we know about his departure from OpenAI?
We don't know a ton more. He was involved in the original ousting of Sam Altman as CEO. He was on the board of OpenAI at the time and originally sided against Sam. And then he was instrumental in bringing Sam back just a couple of days later. And ever since then, he's been in this state of limbo. It was unclear. Was he going to join the company? Was he upset by things? Where did things stand? And that went on for several months until mid-May when he issued a tweet and he said, look, I am leaving OpenAI. There didn't seem to be bad blood, but he said, I'm going to do, my own thing next. And we haven't known what that was going to be until yesterday.
All right. So tell us about Safe Superintelligence. This is his new venture. What do we know? What did you find out?
Yeah, I mean, it's kind of incredible. So in AI industry lingo, people have been chasing this AGI, an artificial general intelligence. It's usually described as basically human level or a little beyond human. What he's going after is this super intelligence. This is beyond human capabilities. To be clear, nobody actually knows how to build this yet, and we don't even know if it's possible. But he's put a flag in the ground and he said, look, I'm going to build this thing, and the key here is that he said he's not going to sell products and services along the way like all of the other companies. He sees this as a conflict for them. And so he's just like going into a cave, and he's going to emerge with this super intelligence.
Okay, not selling any products or services, at least in the near term. That sort of maybe is a good segue to talk about how he thinks philosophically about for-profit, nonprofit, and the role of a research organization and how it sort of collides with a for-profit organization.
Absolutely. He named this company Safe Superintelligence Inc., which, some people have maybe a giggle at, but, he's making safety to be this priority. And he clearly thinks that if you have to make products, you've got these other, masters to cater to and conflicts that arise from this. And that the only way you could really make a safe AI, which again, we don't really know how to do, but if you were going to try to do it, you'd have to do it unfettered by all these other conflicts. And he said he admits that we don't really know how to do this yet, but he's famous for coming up with breakthroughs in this field. And he said that's what he's going to try to do here around not only making this new form of intelligence, but adding actual engineering into it to make it safe.
All right, Ashlee, cue my sarcasm. So I can see the pitch to investors. Hey, guys, I'm going to do this really super intelligent AI and we're not going to make any products or services. So I don't know how we're going to make money. But hey, we're going to do this. Give me money. Give me money. I mean, who's funding him?
It's a bold pitch. There's not many people who could get away with this.
That's true.
I think we don't know exactly who's funding him yet. And normally, my skepticism radar would go off pretty hard, but I suspect they will not have trouble finding money. I mean, this is the guy who's probably the most famous AI researcher in the field saying, I might create the one product to rule them all. If you want to go on this adventure, come with me. And so I suspect they'll find money. But the amount of money we're talking about here is dramatic. To build these models today, you're talking about 1 billion to tens of billions of dollars of pure compute power that you need. And so, this will be quite the gamble for whoever takes the ride.
Well, let's go to the heart of this and the safety concerns that researchers have had when it comes to AGI. How would you summarize the way that Sutskever thinks about safety in AI and AGI, and what are his biggest concerns?
What's interesting, he's kind of like so many people in this field. He has been tweeting for years that he is concerned about where AI is heading, how powerful the technology is, what it could do to humanity, and yet, like almost all of these people, he's chasing it as fast as he can. So, this has been top of mind for him for a long time. If you look at the major AI players today, they all talk about safety. We can have an argument of how serious these discussions are. A lot of times these models get built and then you try to tame them after the fact. He seems to be saying, look, we need something like a kill switch or something embedded in this code where you could turn this thing off if it was going wrong. And nobody's figured that out yet, even though intellectually people have talked about this for decades. Nobody's actually done it. And so I think that's the difference he's trying to make. He hasn't said a lot, so you're kind of parsing what we can out of his words.
I feel like you need a 23andMe in the AI space to kind of connect all the players who are kind of connected, because I want to bring in Elon Musk. We were just talking about him earlier, someone very, very well and I've written about extensively. I'm just curious about how potentially maybe what Ilya is doing, and of course Elon has raised $6 billion to kind of challenge OpenAI. He cares about, he says, safety in AI. I'm just curious how you were thinking about maybe how some of these players could possibly come together. Are they all just going to compete against one another and work together?
It is like a soap opera. This is like they were all part of the original boy band at OpenAI, and now have kind of broken up and gone their separate ways. Ilya and Elon historically were very tight. I mean, they really were part of this kind of core that started OpenAI, and now have diverged. I cannot confirm this for sure. What I'm hearing is Elon is not going to be funding Ilya's new venture, and we did see a tweet this morning where he was kind of commenting on the name, and so it looks like he's skeptical of what Ilya's trying to do. With Grok, Elon's AI, his big push. So Elon has been afraid of where AI is going, but we haven't seen necessarily this big emphasis on safety from Grok either yet. Elon's mostly been pushing against what he sees as the political correctness of these other AI systems to date. And so I don't know. I cover this stuff a lot. I think it's all a mystery. I think people are not very clear on what they mean about safety or any of this stuff. And so there's much to be done still.
Okay, well, speaking of the original sort of boy band, Anthropic is a name we haven't mentioned yet, and that's another company that was started by former employees of OpenAI. And today they came out with some news unveiling the most intelligent AI model yet to vie with OpenAI. Where does Anthropic fit in with all of this?
They're part of the boy band. They were started by a bunch of guys who, men and women who had made GPT-3 more or less within OpenAI and seemed to have had a fracture over where they saw OpenAI going, especially on this trust and safety stuff, and so broke off to start their own company. They've been incredibly competitive very quickly, obviously a very smart team over there. And so, yes, they just released this new model today. It seems to be doing very well on these early benchmarks. it seems like there's this race where somebody does a new model, somebody else catches up quite quickly, and nobody is lightning years ahead. Anthropic's big thing has been that they take safety perhaps more seriously than anybody else, and that's been kind of baked into their DNA and the things that they say. Again, it's not totally clear how that manifests itself in the engineering of the systems.
All right, because you're you. HBO documentary. This has got to be exciting. Can you tell us just real quick?
It's really exciting. Yeah, thank you. So next month, July 17th on HBO, we have a documentary coming out called Wild Wild Space. It's all about the rise of commercial space. I spent 6 years with a camera following a bunch of rocket companies and satellite makers around. It's co-produced with Steven Spielberg's Amblin and Adam McKay's Hyperobject. And I think just asking people to tune in next month when it airs. And I think it's a really interesting, unusual look at startup life, the rise of commercial space. We had cameras in when rockets were blowing up, in the mission control. You get to see how people react to that. So it's been a fun journey.
All right. Great stuff as always. Looking forward to that. That's coming out, as we said, HBO documentary in July. And then we're going to look forward to the Boy Band AI Summer Tour documentary that you're going to do, because at some point that's going to happen as well. Ashlee, thank you so much. Really appreciate it and get some time with you. Ashlee Vance, he's Bloomberg Businessweek features writer. You can check out Ashlee's story on the Bloomberg and, of course, at bloomberg.com/businessweek.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, for decades, every week, Bloomberg Businessweek taps into the top stories in the worlds of business, technology, politics, economics, culture, and so much more. The stories everyone is talking about, the stories shaping our investment world, and really, Tim, the world at large.
Well, that continues along with a monthly Business Week issue. It kicks off next week, and here to talk about it, the editor of Bloomberg Businessweek, Brad Stone. He joins us from San Francisco. Brad, the author of Amazon Unbound, Jeff Bezos and the Invention of a Global Empire, among other books. Brad, good to see you this afternoon. A monthly, that's what I want to talk about, the relaunch here. How does that change things editorially? How does it make you think differently about the cadence here?
Yeah, thanks, Tim and Carol. And of course, you guys are a big part of the relaunch. In some ways, not a lot is changing. Business Week, despite the name, has been a daily for years. We publish online on all Bloomberg digital properties on the Bloomberg terminal. We publish on Apple News Plus, and that's not changing. The quantity and quality of Business Week stories and the fact that you can find them online every single day is not changing at all. The print magazine is, as of next week, becoming a monthly. I would say as a monthly, the fact that we've got 12 issues a year, it means that our ambitions are higher. They're greater. The kinds of stories we're telling, the kinds of people and companies that we're putting on the cover, we're going to be absolutely certain every month that they are the companies and the people that are making a difference in global business, and where we can not just ask but answer questions about what they're doing and how they're doing it.
Gotta say, Business Week has always been one of those things that is kind of out there ahead of everybody else. And it's like all of a sudden we've been talking about it, you guys have been talking about it, and then everybody plays catch up, to be fair. Having said that, how did you guys think about this first monthly issue? And as you said, you're publishing daily, so stories are constantly coming out. But when you think about a monthly and what you wanted to put in the actual publication, how did you kind of address that?
And Carol, I cannot wait to come back next week and talk about the first cover story, because essentially we asked, who is not just one of the most powerful people in the world, but one of the business figures that is perhaps the least understood. And that's the first cover story of the July issue of Business Week, and we'll talk about that next week. But we've also included in the magazine some of our most ambitious and aggressive investigative journalism. So we've got a story from two of our Singapore correspondents, our editor Matt Campbell, our metals correspondent Annie Lee, and they visit Indonesia and the island of Sulawesi, where there are mining facilities that are basically refining nickel, a commodity that goes into many of the world's batteries and is key to the supply chain of electric vehicles. And they chronicle, just a litany of almost jaw-dropping, not just environmental abuses, but worker abuses at these facilities in Sulawesi, in particular, a kind of mining community called the Indonesia Morowali Industrial Park, or IMIP. And it's just hair-raising stuff. It will make you think differently about the global supply chain, about some of the components that are going into the world's batteries. And, it's really representative or characteristic of the kind of storytelling we're trying to do in the new Business Week, not just the profiles of the companies and executives who we all know and wonder about, but reaching deeply into the world of global business, with some of our best investigative reporters in the Bloomberg newsroom to tell those surprising stories.
Yeah, and kind of the conflict of what is green, right? Like you think EV, right? Great for the environment, like this whole idea, this big push globally. But then when you get into kind of something like the battery production or where the supply chain, what are the sources? Is it responsible? It's not necessarily playing out that way.
Well, look, we want to be clear-eyed about this. Electric vehicles are, bottom line, better for the environment. I think that a lot of the car companies, and we represent their viewpoints in the story, recognize that the nickel production, particularly in the first generation of electric vehicles, that there was a pretty bad environmental and worker and labor record there. And they've tried to, I think we see that, for example, subsequent models of Tesla do not rely on the same quantities of nickel that previous models did. So there is a recognition. It might be somewhat belated, but with this story, we really kind of lay bare one of the ugly dimensions of the supply chain.
Okay, well, speaking of the complexities of global business, a few years ago when Russia invaded Ukraine back in 2022, a lot of businesses that are based in the United States pledged to stop doing business with Russia, stop selling their products in Russia. One of those was Coca-Cola, Brad. In the upcoming issue of Bloomberg Businessweek, you dive into the complexities around doing that because, hey, you can still get a Coca-Cola in Russia.
That's right, Tim. We in the new magazine, readers will find that there's a whole new front of the book, and the first section that you'll encounter we call In Context. And they're shorter stories, lots of kind of graphical presentations, photo heavy, some interview franchises that we're developing. But then we're just kind of asking and answering some basic questions. And we did wonder, so after the 2022 invasion of Ukraine, when all those U.S. companies pulled out, like how real and how permanent was that? And the observation that came back from some of our reporters in Russia and in Eastern Europe is, you could still find suspiciously red cans and bottles of soda. And the answer is, Coke in particular is widely available. It's getting imported from neighbors like Kazakhstan and Georgia. And then the bottlers, through some complicated kind of corporate ownership structures, have essentially renamed their soda. And I think in Russia now, where you can still find Coke or the offshoots, it's called Dobry Cola, and essentially it's the same thing. So, some I guess maybe the commitments were a little soft, and we've seen them get softer as the invasion goes on.
And not just Coke, there are a few others, right?
Oh, absolutely. Coke obviously is the icon, so we looked at it. But when you go through lots of recognizable American franchises, starting with Pepsi, also you can get either imported versions of it or their suspicious offshoots.
All right, so let's get to one other story that's in there. And I feel like as we are dealing with another heat wave here in New York City and a big chunk of the country, communities that are dealing with it and how they have to kind of change their strategies, especially when it comes to fire and fire mitigation plans.
Yeah, so this is a collaboration between Businessweek and Bloomberg Green. We have a section in the new magazine that we call In Depth, which is really a part of the magazine for packages of stories. And we asked Bloomberg Green to help us look at how cities are adapting to climate change. And so we look at cities like Sao Paulo, that's developing these kind of spongy rain gardens to deal with the increase in precipitation. And then Boulder, Colorado, which is pushing a new agenda, junk your junipers. So obviously juniper trees prevalent in the area, but they're basically tinderboxes and they can spread forest fires and wildfires. And so there's all sorts of campaigns to either, cut them down, remediate forests, or even entrepreneurial efforts to create kind of new kinds of mushrooms or fungi that will draw the moisture from some of these forests. And we see cities like Boulder really increasing the budgets for climate resilience. I think it was $4 million a year to now almost $7 million, or 2% of the city's operating budget. So cities really at the front line of trying to address climate change.
And I think what's complicated in the tension in this story is that Boulder's a place that people live to, because of its proximity to the outdoors, to do cycling, to go climbing, to go whitewater rafting. And it's these areas of the country and of the world that increasingly are presenting the biggest risk when it comes to fires as a result of a climate that is getting warmer, Brad.
Yeah, and it's probably a paradox of living in a place like Boulder. You seek the outdoors, and yet every time it gets real hot or the winds start to blow, we have people in the story talking about just anxiety levels shooting up because they've had some really near misses over the past couple of years, and I think they're on the front line of recognizing that they cannot wait for the disaster to come to them, that they have to engage with their environment and look at it in a new way and be aggressive in trying to stem the threat from climate change. It's one of those communities that's growing so quickly that it has really spread out into natural habitat that probably weren't meant for this kind of development. So Boulder is a great example of how cities are being aggressive in taking some steps to prevent the worst from happening.
Well, Brad, looking forward to the new monthly issue of Bloomberg Businessweek when it comes out, and to the cover story. You definitely have us intrigued. So thanks so much for stopping by and chatting with us. Brad Stone, he's Bloomberg Businessweek editor, joining us from our bureau there on the West Coast.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, we want to get to our next guest. Déjà vu all over again when it comes to stocks. So says our next guest, as the S&P 500 takes out another record. But again, we were above 5,500 on the S&P 500. We've pulled back. The NASDAQ 100 was headed for another record. We've pulled back. So that is your Thursday in a nutshell.
Well, we got back with us in the studio, Jeff Krumpelman, Chief Investment Strategist and Head of Equities over at Mariner Wealth Advisors out of Cincinnati. Jeff, good to have you back with us. The S&P 500, so far this year, we're only halfway through the year, not even. It's already achieved your 2024 target range. It's actually surpassed it because that was 5,200 to 5,400.
In a big way.
So, what do you does that mean that the gains are there for the year?
So, that's kind of why I led with it's déjà vu all over again, because we were at the same place last year. We had that nice rip-roaring market through July and surpassed our target of the lower end of our target of 4,500, by the midway point. And people kept asking, are you taking your target up? And it was a different environment because that was a contrarian view in 2023. And our answer was no, but we do think the trend is still positive longer term, and active management can add value. Same thing this year. Same thing this year.
So longer term, you mean next 6 to 12 months, or you're saying like 5 to 10 years from now? Like
No.
So what are you saying longer term?
So I think in 12-month, rolling 12-month increments.
Yeah.
So what we do is introduce our crystal ball at the beginning of each and every year. We tell people exactly where we think it's headed, why it would go there, and then what could go wrong and make us adjust our view. And we revisit that at halftime, middle of the year, and look out another 12 months. Seldom do I do a lot unless the environment's changed significantly to adjust that year-end target.
So you're not upping it at this point?
No, absolutely not.
But you're not reducing it either?
Not reducing it. And I do think that the trend is, up if you look over the next 12 months. There, you mentioned, today that I think just the tape play there was that perhaps there's a little buyer exhaustion. We've got an election coming up. We've got a lot of things that could just annoy people temporarily. We all get crabby, and we're not good enough.
No, we never get crabby.
Hangry. We get hangry.
Except for you guys.
we do get hangry.
Yeah, that's true.
A lot.
I get hangry too.
Yeah. So maybe people get grumpy or annoyed by the election, but is there anything bigger that you should have perhaps on your radar in terms of what could send stocks lower, what could kind of derail this view?
Yeah, I think the biggest thing, and this goes back to actually October of 23, the number one risk item on our radar would be rates. And they're calming, they're stabilizing. But when we made that push up to above 5% last year in the fall, that made us nervous. And if we would have adjusted our view, it would have been that. What would have done that? Bond vigilantes that would have been nervous about inflation and just, Treasury supply demand at those auctions and, worry about enough buyers coming in where we got record levels of debt. That all seems to be kind of stabilized. Inflation is calming. Supply demand in these Treasury auctions are, positive, constructive. And so we think that what will get the headlines is earnings, still very resilient economy. And as we move through the end of the year, boy, oh boy, if we do get a Fed rate cut, and we kind of stand away from all this rhetoric about what will the Fed do.
But if we don't, it's okay. You'll hold to your guns, if you will, in terms of your S&P 500 target.
Yes,
even if we don't get a cut this year.
Even if we don't get a cut, and I think that they are in a very good place right now because we're not on the cusp of recession, and inflation really is calming. And I think I know how it is when we're in a meeting and we're getting ready to put out a big report. If you come in hours before that report is just ready to be printed, and you give me some data that I could probably tweak it, generally you just kind of go, it's okay. And they got some really good news on the inflation front before they did their presser.
I want to talk names because Kava is, you kind of have four areas that you like: consumer, healthcare, tech, and industrials.
Yeah, I'd say so.
Right? I think materials also kind of, right?
They fall in that boat.
So maybe,
Right.
Kava is one of those names, and Tim and I have talked about it, and this one is up more than 300% since that June 2023 IPO. Why do you think that there's more momentum to the upside here?
Oh, because it's so early stage. So this is like Chipotle 20 years ago. They actually got into the business by buying Zoe's Kitchen. They only have 300 outlets. They're growing units sales, or unit stores, square footage growth, 15% annually. And they're early on in introducing these new stores. So promotion expenses will go away, margins increase.
You're not concerned by the valuation? We had Bailey Lipschultz in here last week who wrote a story about how the average restaurant at Kava is valued at $33 million, which is just an astronomical sum, even if you go back to the halcyon days of Chipotle early on.
I'm not worried about it in its early growth stage. We're talking about 75 to 100% earnings growth from 25 through 27. So they're just getting started. They're pushing really good top line sales, and it's a great concept. This is Mediterranean, and you could argue there is or isn't, competition there, but they are more than twice the size of any competitor, and they're implementing and executing, expanding better than anybody else. So this is kind of like saying, are you concerned, Jeff, in small biotech about valuation? And the answer generally is no. If there's revenue momentum, no, I'm not. There will come a day that I will care about that.
But going back to it, okay, so because that's a huge. So we're kind of comparing them at similar stages, right? When Chipotle IPO, their stores were valued at about $3 million per restaurant. So we're looking at Kava, that's $33 million. Like, that's okay. So they're kind of at when they were at the same stage. That is such a big difference. You're comfortable with that.
I think they're going to just grow into, earnings went up.
Grow into the growth we've already seen in the share price?
Their estimates were something like, they've come up 30% for 2025 in just a couple months' time.
Okay.
So it's execution. And what is the earnings number? It's going to come up significantly. And so, yes, I feel like this is a momentum play. You got to know, different stocks trade differently. This is really a revenue story, expansion story, and that's what will make it a successful investment.
Okay, DraftKings. We don't have a ton of time left, but I do want to talk a little bit about DraftKings because in recent weeks, we've seen some legislation that could raise taxes on sports betting come from states, including Illinois. How do you think about that kind of legislative risk?
I think that they'll get more licenses in new states, and we've kind of done a little bit of checking where we could. It's not likely we get an avalanche of tax rate increases state by state. They are so starved for tax revenue, that they want this kind of stuff happening. So, the story there again is pretty simple, and you got to stay on top of it. But it's the best platform. You talk to anybody about where do you really like to, place your online, bets, and they'll tell you it's DraftKings. So, like Kava, stop that promotional spending. You get margin expansion, in a great addressable market.
Stay tuned. Both have had tremendous runs, certainly this year. Jeff Krumpelman, thank you so much over at Mariner Wealth Advisors.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Okay, the quiz. I'm going to give it to you again, and you're going to have to try.
Yes.
Enrique Iglesias, Blake Shelton, the rapper Future, the rapper and producer Logic. What do they all have in common?
They're selling their music.
Yeah, they've all sold their catalogs or stakes in their catalogs. To Influence Media Partners. It's a $750 million fund. It's backed by Warner Music and BlackRock. It invests in music IP. And the company says that as of last year, they've got about $600 million in music IP with more than 24 catalogs.
Pretty cool stuff. We've got with us Lylette Pizarro. She's the founder and co-managing partner of Influence Media Partners, joining us right here in New York City. Lylette, nice to have you here with us. So, how busy are you guys? I'm just curious. It sounds like you guys have been putting money to work. But how busy are you? Are there a lot of musicians who are coming and saying we're looking to sell? Are you guys reaching out to a lot of musicians? Tell us a little bit about kind of how this industry is working.
Hi, Tim and Carol. Thank you so much for having me on your show today. The market is vibrant. There's so much opportunity. In fact, today we just talked about how healthy pipeline is. And in fact, in terms of larger single artist acquisitions, this has been probably the healthiest we've seen in the last few years in terms of billions of opportunity in single artist acquisition opportunity. What's gotten really interesting about the market for us at Influence is that artists really do care about partnership. And NIL has become a very vibrant space.
Name, image, and likeness is what you're referring to.
Yeah, name, image, and likeness. And, when I wrote this strategy a few years ago, I wasn't quite sure if the active artist, an artist who has a manager, an agent, a really, significant bench of talent would allow us to invest in their name, image, and likeness rights. But
well, help us understand name, image, and likeness when it comes to these artists, because we talk a lot about it in the context over the last few years of athletes in college who are now able to license their name, image, and likeness. How does it work in the musician space, in the artist space?
So everyone has a different approach around how they manage name, image, and likeness rights. I can tell you what we do at Influence. As it relates to Influence, we approach it as an opportunity to invest in a specific vertical of rights. So we look and we learn, we do insights work around how the artist has commercialized their name, image, and likeness rights historically, and what might be a white space. So it could be wellness or hospitality or film and television, or an area that they haven't really explored, but there's interest in exploring. And we'll approach it around taking a position on those rights exclusively.
Isn't that kind of what an agent does? Like, I'm just curious where you guys come in. So in other words, right?
We partner with the agents very often. So I would say we look more like a marketing agent, which is more classic in sports and doesn't exist in music. And I feel like that's the white space that Influence is really owning. So a marketing agent who will work in tandem with the television and commercial agent and the touring agent, but we're specifically focused on bringing new marketing opportunities to artists, and on a very specific, basis. We also work with artists on non-exclusive rights as it relates to name, image, and likeness. But the proposition, given the type of talent that exists in Influence and the type of marketing DNA that we're bringing in, it's become a very compelling proposition to talent, in which now we're being approached just on name, image, and likeness opportunity outside of catalog investment.
That's what I was going to ask you. Are there times where a performer says, yeah, we're going to hold on to our music, but can you help us with can you help us with the name, image, and likeness side of the business?
Yeah, it's just started to happen. It's, We're in early days of, influence. So we're very much a startup, but it's so exciting and promising to see artists respond this way, see the opportunity, and want to lean in on what we're proposing, our ambition and our strategy. I will tell you, Carol, that our marketing pipeline is just as important to us as our acquisition pipeline. We really believe that if you're investing in IP, the best way to protect IP is to constantly drive rediscovery of that IP and make sure that it's at the forefront and there's ways to consistently re-engage with fans and audience. And that is at the heart of our proposition.
So as I mentioned, it's a $750 million fund. It's backed by Warner Music and BlackRock. What can you tell us about fund returns over the last couple of years?
So we've done very well. I mean, investing in music royalties, as you guys know, it's an alternative investment class, but we've been performing a little bit better than I think the market would say that these royalties or investment in music rights perform. And part of it is because, one, we're highly focused on our value chain proposition. So from sourcing, we really look at, making sure that the seller, so whether it's an artist or songwriter or an entrepreneur, truly cares about partnership and wants to lean in on value creation and marketing opportunities. So it makes what influence invest in a little bit different than the balance of the market.
Right. Lylette, the S&P 500 is up more than 30% since late October. Are you outperforming the S&P 500?
No, we're not outperforming the S&P 500.
What can you tell us about expected returns, though, when someone comes to you it's an alternative asset, as you mentioned, it's alternative investment?
I think what the market has said about these returns is that they are low to mid-teen returns, and influence is performing better than mid-teen returns.
All right.
All right.
Cool.
Just trying to get an idea of kind of where it fits, right? We talk a lot about alt investing. So it's just trying to get an idea of exactly kind of where it kind of slots in the investment space. Having said that, I don't know, how big can it be for you guys? Tim mentioned how much you've got a $750 million fund already $600 million in. Are you getting new investor money coming in to either do a second fund or build out this fund?
Yeah, so our investors are really happy with our performance and are returning to our next vehicle. I think the question always is, what's the appropriate scale for this investment class? And we're working to define that as well. Look, we see ourselves as a premium rights holder of premium music rights. And so we also very much care about having the opportunity to partner and actively manage. And I think we've identified our space in the sub-early billions of opportunity for the future. So, potentially a $2 to $3 billion vehicle. I know that there are other buyers in the space who have far larger ambitions, but right now, that's how we see the opportunity at Influence.
There was a period until about 2022, we were talking about this all the time. Kenny Chesney, Leonard Cohen, Justin Timberlake. Those were catalogs acquired by Hipgnosis and Blackstone, John Legend, Bruce Springsteen, Stevie Nicks, Bob Dylan. They've struck deals with other firms. Has the idea of selling a catalog slowed down at all in a higher rate environment?
So, what I will say, there has been just as much activity in terms of acquisition, and there has been just as much activity in terms of new entrants backed by institutional investors. But what has shifted is the actual announcement activity. And I've been looking and studying that. Even as us as Influence, we've only announced 25% of our acquisitions.
Interesting. I was wondering about that because I saw the numbers versus who you've announced. But you say there's more people out there to do the acquisitions, the more institutional money. Doesn't that make it more expensive for you? We only have 30 seconds left, but if there's more places for these artists to sell, doesn't it increase competition?
Yeah, competition continues to get more and more competitive around music rights. So what's critically important is understanding your proposition around value creation, being able to have deep trust in the space. Sourcing truly matters. So proprietary sourcing or limited opportunity matters and gives you a bit of an advantage. So yes, as it continues to get more competitive, being able to be thoughtful across the value chain is critical.
Listen, really appreciate you being so real and transparent. Really fun to talk with you. Lylette, take care and look forward to hearing more in the future. Lylette Pizarro, she's the founder and co-managing partner of Influence Media Partners, joining us right here in New York City.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, this is a market that can drive you crazy. As Tim and I have been talking,
Unless
we
you
talked
just
about with Abigail.
invested in NVIDIA 5 years ago, then you're like, I'm fine.
You
no
know
problem.
what? You're just
10 years ago,
sitting
NVIDIA.
on an island
Yeah,
somewhere.
Exactly.
Yeah, talk to me.
Sorry, I cut you off, Carol. Go ahead.
No, it's okay. It's just been kind of a little bit of a wacky day, but we've had quite a run in equities over the last week or so. Let's see what our next guest has to say. In our drive to the close, we have Eric Jackson with us. He's founder and president at EMJ Capital, back with us on this Thursday, joining us from Toronto. It looks like we need to put like a prison cell number under you.
Oh,
just
Carol. Oh.
The background. We need
That
to
is
like
so-
spruce it up for you, Eric.
All right, you be good cop, I be bad cop.
I didn't bring my green screen today, Carol.
Oh, okay. All right. Well, then you get a pass. I'm sorry. I'm like Captain Obvious today.
That was so out of character for Carol. The entire I could hear the control room behind soundproof glass.
I'm a little surly today.
Yeah, you are.
I blame having that day in the middle of the week off. Like,
all right,
it's
go
just-
easy. Go easy
Throw me
on
off.
him.
It doesn't mean we don't like you, and it doesn't mean we don't want to talk to you. I'm just, checking out the background. How are you? And I don't know, what are you making of not just this day, but we've had quite a run up in the equity markets and trying to figure out, do we continue the march higher, or is it time to just kind of take a breath because of the gains that we've seen?
I think it's time to stay the course, Carol. I would say that it's been a great run. It's been a surprise. Obviously, tech has led. But, in my opinion, tech always leads. I mean, that's why I focus on tech. And so people always get most excited about where the most exciting growth stories are. And those tend to always be in tech. And so NVIDIA's obviously the poster child for that excitement right now. I am long NVIDIA. I see no reason to get off the train, even though it's pulled back today. But, this is coming off of, I don't know, eight solid days in a row or something like that. So
yeah.
It can't go up every single day, and I'm not a fundamental analyst, but I do know that. Hey, Eric, I'm wondering, when did you get in on NVIDIA? Like, how much of a rocket ship ride up has this been for you?
Well, I've been in it off and on for the last couple of years. I was not in it a year ago when there was that May earnings a year ago where the thing just like shocked Wall Street and took off. And that was the moment where people realized, GPT, ChatGPT, and AI and NVIDIA. Okay, I can put it all together now, and NVIDIA is going to be kind of the main beneficiary. So I would say most of the gains, Tim, have been since then. But I've been in and out, but solidly in it. I think since for most of this year, anyway.
Well, it's interesting too. Go ahead. No, please.
Well, and definitely after the last earnings, I thought that there were a bunch of breadcrumbs in the last earnings, where basically before earnings, I think this was something like mid 600s or something, in the old stock price, and basically it's been kind of straight up to now 1400 in the old stock price as of this morning, and now we've pulled back here in the afternoon. But I just think like at some point, people's skepticism about just the magnitude of the beats that we saw last year, it started to settle in that, even though this thing has been enormous, and even though it tripled in 2023, this stock on a forward price earnings basis is actually cheap relative to the last 5 years and where it's traded.
Wow.
And for this thing to trade at an extreme level, which I would define as like 1.5 standard deviations above the mean on a forward PE basis for the last 5 years, you'd have to see this thing go to $200 a share. So I don't think we're at the euphoria stage yet for NVIDIA.
So as long as people continue to spend, right, and do the build out, the AI build out, Eric, you're kind of cool with this. And we'll get another check when they report earnings, in about a month or so. So we'll get an idea of whether or not, actually it's kind of about late August that we get a feel, but we'll get an idea if any of it's slowing down.
Yeah, and I think what we will start to think about as we move into the second half of this year is that how many of the people kind of new to NVIDIA are really au courant with like Blackwell chips that are coming, and then the Rubin chips that are coming after that. And so, people are barely kind of getting to know, H100s, H200s. But I think as it starts to sink in, the Blackwell chips that will start to be coming out are at a much higher price point, so even better gross margins for NVIDIA, and more powerful, and then you use less power and all this kind of stuff. They are really the only game in town, and will be for a while. So that's when I think you could see this sort of re-rating, and perhaps, a run back to the euphoric stages of where it's traded in the last 5 years.
Eric, I know you're long NVIDIA. Well, I want to get to some other names just in the last 2+ minutes that we have with you. Where are you short right now?
That's a good question. Like, there are, and I don't want to kind of talk specific names, Tim, but I would say definitely the SaaS names are places that are kind of use of funds.
That's interesting.
And have shown to be over these last, they're as CIOs are allocating budget towards AI this year. It's pretty clear that at least they're not increasing SaaS budgets, and I think that's what's hurt names like Salesforce this year, and a lot of the other kind of smaller to mid cap, one trick pony, one story SaaS companies that exist out there. So I think those are the names that I am, I think still could correct further down in the remainder of the year.
All right, we're going to go there. We don't normally go to a stock that trades for $1, but there is something on your radar. Defy Technologies, DEFTF is the ticker, very small market cap. On Tuesday, it was down the most in 3 years. It was down about 27%. Why are we talking about this name, or why are you talking about this name?
Well, I'm bullish on crypto in general, Carol. And I am long Coinbase and have been for kind of most of its big run over the last couple of years, and continue to be bullish on Coinbase. But it's for all the talk that crypto gets, there are still a real lack of equities to play if you're interested in crypto. There's obviously Coinbase, and then there's the miners, whose margins aren't that great, frankly. There aren't that many great names. And I came across this one that's a real small market cap, like you say. But Anthony Pompliano, who's a big crypto investor, he's probably been on your show. He's an investor in this company, and he sort of tweeted about it a few months ago. And it really was interesting to me because they run a bunch of ETPs or ETFs over in Europe that are crypto related.
Yeah.
They make money off of the management fees associated with them, and also they get staking revenue on those. And it's not just Bitcoin and Ethereum, but they have Solana ETFs and some of these altcoins ETFs. And they are very profitable on a go-forward basis. But because they're small, they get kind of ignored. So I like them over the next year or two to kind of close the gap, and they could be a big 5Xer from here. Yep,
$1.47 a share. It is up about 190% this year. All right, Eric, thank you so much. Really appreciate it. Eric Jackson, founder and president of EMJ Capital, joining us from Toronto.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.